Chapter 5 introduced and showed how to use the worksheet. It also covered the preparation of adjusting entries and financial statements. Chapter 6 completes the accounting cycle by showing how the books are closed before the next financial period begins. In this first section, we learn how to make closing entries. Journalizing and posting closing entries is the 7th step in the accounting cycle. Closing entries are journal entries which are completed at the end of an accounting cycle so that the business can start fresh in the next accounting period. Closing entries are journal entries that transfer the results of operations, net income or net loss, to owner's equity and reduce the revenue, expense, and drawing account balances to zero. The income summary account is only used during the closing process. The income summary account is classified as a temporary owner's equity account, which will have a zero balance at the end of the accounting period. Let's further discuss the closing process. Objective 1 is to journalize and post closing entries. There are 4 steps in the closing process. Close the revenue accounts, close the expense accounts, close the income summary account, and close the drawing account. The closing process begins by closing out all revenue accounts to zero. By reviewing the worksheet from the previous chapter, we will note that we only have one revenue account, fees income. So we need to close the one revenue account to zero. Currently, fees income has a $47,000 credit balance on the worksheet. Fees income is closed to the income summary account. To record a decrease in a revenue account, debit it and then make a corresponding entry to the income summary account. The revenue account, fees income, is decreased by $47,000 to zero. The $47,000 is transferred to the temporary owner's equity account, income summary. Fees income would be debited for $47,000 and income summary would be credited for $47,000. Here is our first closing entry represented in T accounts. Please note that after this closing entry, fees income has a zero balance. That was the goal of our closing entry, to get the account ready for next year with a starting balance of zero. Here is the first closing general journal entry. Notice that the notation, closing entry, was written above the first closing journal entry. Step 2 is to close all of the expense accounts. Since expense accounts have a debit balance, we need to credit them to close their balances to zero. When closing the expense accounts, we will transfer their balances to the income summary account. Since the expense accounts have a debit balance, we need to credit them to close them to zero. A corresponding debit will be made to the income summary account. The income summary account will be debited for the total of all the credits made to the expense accounts. Each expense account will be credited to bring their balance down to zero. Here is what the T accounts look like. Each expense account was closed to zero and a corresponding debit was made to the income summary account for $13,333. Here is the second closing journal entry. Notice that income summary is listed first because it is the only debited account. After making the first 2 closing entries, income summary has a balance of $33,667. This is the difference between the revenues and the expenses, or net income. This amount will be transferred to the capital account of the owner. Our third closing entry transfers net income to Carolyn Wells Capital. Income summary has a credit balance of $33,667 at this point. So to close it, we would debit it for this amount and make a corresponding credit to the owner's capital account for the same amount. Here is an illustration of what the third closing entry would look like in the T accounts. Here is the third closing journal entry. Our final step is to close the owner's drawing account. Step 4. The owner's drawing account has a debit balance and is closed directly to the owner's capital account. In this step, we are reducing the drawing account balance of $5,000 to zero. We need to debit Carolyn Wells' capital for $5,000 and credit Carolyn Wells' drawing for $5,000 to close it to zero. After making the credit to the drawing account, its balance is zero and the capital account has been reduced by the withdrawals made during the period. This was another goal of the closing process, to update the owner's capital account. The last closing journal entry is shown here. Carolyn Wells' capital will show a balance of $128,667 on the balance sheet. Here are all four of the closing journal entries. Step 1, close the revenue accounts. Step 2, close the expense accounts. Step 3, close the income summary account. Step 4, close the drawing account. Now, all of the closing journal entries need to be posted to the general ledger. When posting the closing entries, make sure you write "closing" in the description column of the general ledger. Here is the fees income account in the general ledger. Notice that after posting the closing journal entry of a $47,000 debit, it now has an end-of-period balance of zero. After posting to the fees income account in the general ledger, we post to the income summary. The remaining 3 closing entries are posted in a similar fashion. In the second objective of this chapter, we will learn how to prepare a post-closing trial balance for a business. We need to prepare another trial balance, called the post-closing trial balance. Step 8 is to prepare a post-closing trial balance, and Step 9 is to interpret the financial information. The post-closing trial balance is prepared after the closing process. It contains only the permanent accounts which were not closed at the end of the period. It proves that debits still equal credits, and that all temporary accounts were closed to zero. When we interpret financial information, we are evaluating the financial information presented and communicating this information to various stakeholders, both inside and outside of the business. Only permanent accounts appear on the post-closing trial balance. This would include all asset and liability accounts, as well as capital. Notice that debits equal credits on the post-closing trial balance. We can use the audit trail to help us locate errors. Oftentimes, this requires that we backtrack through the process to find where we may have added or subtracted incorrectly, posted incorrectly, or journalized incorrectly. What do users do with the finished financial statements? In Objective 3, we learned how users value the information provided in financial statements. To interpret means to understand and explain the meaning and importance of something. Financial statements help users make all kinds of decisions. Financial statements provide important answers to questions such as, what is the cash balance? How much do customers owe the business? How much does the business owe suppliers? What is the profit or loss? From looking at a balance sheet, you can see that the cash account has a balance of $111,350. Let's look at accounts receivable on the balance sheet. You can see that our customers owe us $5,000. You can also see what the company owes to its vendors. The business owes $3,500 to creditors. Did the company generate a profit or loss? You can tell by reviewing the income statement that the business had net income of $33,667. Objective 4 is the last objective in this chapter. In Step 5, we use the worksheet to prepare our financial statements. In Step 6, we journalize and post adjusting entries. In Step 7, we journalize and post our end-of-period closing entries. In Step 8, we prepare a post-closing trial balance. In Step 9, we interpret the financial information. These 9 steps comprise an entire accounting cycle. Take a look at each one and see if you can remember what was involved in each step of the cycle. After studying the accounting cycle of Wells Consulting Services, you should have an understanding of how data flows through a simple accounting system for a small business. Review the flow and make certain that you are comfortable with the documents and reports.